All right, guys, we're back on here with another live Q&A with Rick Fields, who's the owner and managing CPA over at Associates in Accounting. And this is just a time for us every week to take some questions that we received throughout the week and address them. And you get free advice, and we just get to help you guys out and think through different financial and otherwise decisions that you're trying to make. So we'll just jump right into it. So our first question comes from Chelsea. She lives in Tennessee, and she says, I saw that the infrastructure bill passed in Congress. Are there any major tax changes that come out of this new law?
Hi, Chelsea. I love Tennessee. We spent a lot of time there. Hope you're doing well. So the infrastructure bill was kind of interesting. You know, Congress has been wrestling with both these bills. If you're asking this question, you already know this, and one has passed and one has not. The thing about this bill is that most of the tax provisions are loaded into the other bill. However, there are a couple which may or may not impact you depending upon your circumstances. I will tell you what we tell everyone that asks these questions. Always, always, always make sure that you talk to a tax professional about your specific circumstances to see if any of these things affect you. So there are probably 10 provisions. There are 2 that are worth our time today, and the other 8 I'll talk about only if you're having trouble sleeping and you really want to be bored. So let's go down that path. The first one, there has been a business stimulus credit called the Employee Retention Credit that has been around really since last March 2020, March and April, when that first relief bill was passed. That bill actually created the credit system that said that if you had some damage to your business because it had shrunk due to COVID issues, in other words, your gross receipts were simply smaller than they had been in the past, or if your government authorities, and you live in Tennessee, they didn't shut down much, but if your government authorities where you are shut down your businesses for some period of time, either totally or partially restricted them, then you were able to get some credits for the wages that you paid to your employees. And this credit was scheduled to go through December 31st, 2021, still another 6 weeks out or so. This bill that passed, that's going to the president for signature, truncated that credit at the end of the third quarter, 2021. So the fourth quarter of the current quarter we're in will not be eligible for these credits since this bill is passed. So again, is it significant to you? If you're a business owner, probably. If you're not a business owner, it may be totally irrelevant. The other issue, which is relevant to an increasing number of people, for the last roughly 10 years, whenever a stock is sold by a brokerage house or any other type of investment advisor, Schwab, Fidelity, E-Trade, Ameriprise, pick your favorite ones, right? Morgan Stanley, any of those kind of folks. Whenever they sell a stock, they're required to report to the federal government that a stock sale took place. And that transaction is tracked by the IRS. And then if you don't put it on your tax return, as Jordan and I can both attest to, the letters start coming from the government. And they basically say, you sold stock and you didn't list it on your tax return. And that's true of stock, that's true of mutual funds, that's true of bonds, that's true of anything that those investment companies might handle on behalf of their clients. That reporting has to take place and be reported to the IRS for these purposes. Well, cryptocurrency transactions, crypto assets have fallen under the radar so far. There really hasn't been any reporting of that type. One of the provisions in this bill basically expands the definition of a brokerage house to include anyone who is handling a cryptocurrency ledger. So there's going to be reporting going forward. Now, when is that going to happen? You know, the bill's not real clear about that. I'm looking at the context of the bill right now, and basically it says the definition has been expanded, and the bill is going to have a passage date of sometime in the next few days, most likely. But it does not say in the bill that this will be effective when the bill passes, or it'll be effective January of 2022. It doesn't say. So someone back in the background is going to have to write regulations that define the effective date. My best guess is that it's going to be as of the date the bill passes, which means since it's already November and this reporting typically takes place shortly after the first of every calendar year, there's going to be a lot of panicked cryptocurrency ledger responsible authorities who are going to say, oh my gosh, we've got to report this for 2021, and we have no information to be able to do this. So with that in mind, what's likely to happen is there won't be any real effective reporting until 2022. So those two tax changes are the primary changes that are addressed in this bill. Now, again, if you get to 1 in the morning and you want to look at some of these other ones, just because I'm going to give you a list of 4 or 5 others that are in here, and you're going to see how very non-applicable they are to most normal human beings in this country. They do affect a few people, but not very many. For example, there's an extension of highway-related taxes. Yawn, right? Then in addition to that, there's also an extension of certain Superfund excise taxes. This has to do with environmental types of concerns, those types of things. So the Superfund was established to clean up a lot of things that businesses had created that were economic and environmental types of problems over the past. And the Superfund's been around 20 years at least. So these things were simply extended. Also, if you've got a private activity bond that's being issued to make broadband more accessible to population, then there's some tax changes in there for you too. And if you're emitting carbon dioxide at your house and you need to capture that, actually not at your house, but in your business, there's some tax changes in there for those as well. As you can see, these issues are just not relevant to anyone except those folks in those very specific categories. So long and short of it is, no, it's a long answer, but I want to try to make sure to give you a detailed answer as to what really matters in there. And those 2 issues that I mentioned are really it.
Yeah. Yeah, and Chelsea, will definitely make a video if and when the other bill passes, because there will be a lot more tax consequences that come out of that. One thing I was reading, Rick, this morning on the crypto side, sounds like they are making it so that if you intentionally leave off cryptocurrency on your return, they're bumping that up from a misdemeanor up to a felony with up to 5 years in prison. Have you read that as well? Or
no, I read that. What's interesting about that, Jordan, is that there's no felony for leaving stock trades off of your return.
Right.
So somehow
they're putting it under a money laundering money laundering kind of provision. It looks like that stocks and bonds normally wouldn't fall under, I guess. So to say all that to say, I think they're really trying to crack down on this space, which I know we're gaining people who are interested in that stuff on the channel and things. So just to mention that.
What I find most interesting about that, Jordan, is just tongue in cheek. How can it be money laundering when it's not even money, right?
Right. So, yeah, they got to make up their mind.
The federal government doing its work as it normally does.
Yeah.
My guess is that will be addressed because once this reporting provision kicks in and the reporting is taking place, some of the teeth that are in things like that just won't be necessary anymore.
Yeah.
So, but today, at least it's an issue, right?
Yep. Cool. All right, Chelsea, I hope that's helpful. All right, we'll move to the next one. You guys can see, might be able to see my pup there. He's also joining us for the question and answer session. So, all right, from Steven in Colorado, sounds like he has an S-Corp and his business did really well this year. So he's heard about options for pretty much retirement plans inside of his S-Corp to defer out some taxes. Sounds like he's going to net roughly $80,000 this year from his business. And so he wanted to pick your brain on what small business retirement plans would you suggest for him to look at?
Oh boy, great question, Stephen. And hope you're having fun in Colorado. Basically, the bottom line with these retirement plans, this answer is going to take a little different direction than what you anticipated. And it's really probably beyond the scope of a quick question, but I'm sure that Jordan and I would be more than glad to talk with you individually and give you a more detailed answer. either by email or by phone. So let me explain the answer in general terms, and then you'll understand why that I'm prefacing my answer with that particular comment. So what happens with retirement plannings, especially in an S corporation, is that there are a realm of possibilities. There's about 5 or 6 major categories of retirement plans that are available to an owner in an S corporation. Which ones apply best? Boy, that changes tremendously based on your circumstances. Do you have other employees? Are you already taking a salary out of the business and your $80,000 worth of profits are after your salary? You know, those types of things are relevant questions that dramatically change the answer to your question, which is what would we recommend? So what I will describe to you is the process that we undertake when we are answering this question for our clients, because it's a very common question. It's one that I answer probably 25, 30, 35 times a year. I haven't counted, but it's a significant multiple dozen type of question that I get over and over and over again. So short answer is, at one end of the spectrum, there's a $6,000 or $7,000 IRA available, depending upon your age, of course, that is just an individual retirement account. And anybody can kind of do that if they meet the qualifications. That's at the low end of the spectrum. But if you're talking about $80,000 and you have the desire to put all $80,000 in a retirement plan, then we have plans that will do that as well. Well, most people I talk to will say, no, I don't want to put all of my profits in a retirement plan. I just want to put some of them in there. So the answer to that question, somewhere between a basic IRA and all of my profits, is the determinant in whether or not you need a SEP plan, a simple plan, a KEO, a 401k, or there's even these super plans these days called cash balance plans that can allow you to probably even put more away than your profit. If this is only one of your income activities and you have a lot of other income from other sources, we could probably put more than your profits into a retirement plan. So I always start this conversation with a client the same way. I always say to them, what's your goal? What is it you want to accomplish? And if their answer is, I'd love to put $30,000 away, then that immediately tells us, almost like a flow chart, well, that's this type of plan over here. We know what type of plan will allow you to structure your compensation and put $30,000 into a retirement plan. I will tell you that time is of the essence with these decisions. Many of these things have to be done, not all of them, but many of them have to be done before December 31st. And depending upon whether it's just you or whether it is more employees involved in your business, will determine many of the criteria around which types of plans can be put in place this late in the year. Some plans that are very desirable have to be put in place before September 30th, for example. So we're already past that date for 2021. So Stephen, your question is simple, but spreadsheet-like in its answer. And we can fill in the various data pieces of the spreadsheet. What are your other circumstances? What is your tax bracket? How much do you really desire to shelter from tax? We can fill in all of those types of criteria. And then the other overlay that I haven't even mentioned is, how does this fit into your overall finances? So there are goals that are not just tax related that have to be considered as well. So not exactly the answer you're looking for, because you'd like for me to be able to say, hey, Stephen, go start a SEP. But is that the right advice for you? With the limited amount of information we know, I don't know, and I can't possibly tell. But I do know how to get to that answer. Mm-hmm. If you want to engage with us, not so much even just to hire us in the beginning, but if you want to just give us more information, help us to understand the rest of your circumstances, I'll be glad to elaborate on that answer and give you some better direction. Yeah. So let us hear from you.
Cool. Yeah. And at the end of the day, Stephen, it's going to be a tag team approach between an accountant and a financial advisor or a firm that will actually administer the plans, and then we do the tax side. So that's another piece. As you actually have a meeting tomorrow morning with a financial advisor and the client to talk about this exact situation. So you want to try to get if at all possible, get both of those parties at some point on the same call or in the same room to discuss. So cool.
I'll tell you, Stephen, Jordan's comment is right on point, but I will tell you that based on our experience, you want to talk with an accountant first. And the reason is very, very simple. If you're going to start an IRA, you can actually go down to your local bank and do that. On the other side of the coin, if you're going to do a cash balance plan, the very other end of the spectrum, you need an actuary, you need a third-party administrator, you have to have a custodian for the funds, and you have to have an investment advisor. And there are some folks, just like accountants, not all of us are made alike, neither are they. There are some folks that are much more competent in practice in this area that we're talking about. And we know those people and can actually direct you to some of them. Even with you being in Colorado, it doesn't change that type of activity. It's a national type of activity that the providers of those services do not have to be in your backyard in order to do the things that need to be done for you. So first, figure out what type of plan by identifying how much money you want to shelter, by understanding how it fits into your overall financial goals. And then we can schedule the functional pieces that Jordan's talking about and get people involved that can help you with those.
Cool. Okay, Stephen, I hope that's helpful. Our website is in the description of the video, so feel free to book a discovery call over there if you're interested. Last question we got time for today is from Doug here in Kentucky. He says, I keep hearing about inflation and how it continues to rise. Are there any strategies out there that combine the perks of a safer investment, but also one that keeps up with inflation as it continues to grow? Sounds like Ricky's read about different annuities and stock market stuff. Wanted to get your thoughts on the matter.
Yeah, boy, Doug, what a question, right? So let me tell you, we've got about 1,600 clients, and if we were to line them all up and let them answer this question, some of them would tell you that you need to go dig a big hole in your backyard and take all of your money and bury it in that hole. Not a very good inflation strategy at all, right? It's going to be worth less when you pull it out of the hole. Others would tell you that you need to buy banana plantations in South America because that's where the future is. And everything in between, every color and every type of investment in between. So the problem with your question is very, very simple. We can answer that based on hindsight, but it's next to impossible to answer it based on foresight. Well, why is that? Right now, today, there are investors out there and big investment companies and institutional investors that are influencing the markets, even as we speak. There are changes going on, even though the market just closed 3 minutes ago for the day. There are off-market trading things that are still happening right now that will influence values and what happens next and what other investors do. So the problem with the inflation question is very, very simple. In theory, one of the things that the federal government will do with inflation is that they're going to raise the interest rates. So that sounds like, well, wow, if interest rates are going to go up, bonds are a good place to be, right? Because, hey, that means that I'm going to make more interest on my bonds. But if you're already holding bonds, when the interest rates go up, you're holding bonds that have lower rates than current rates, and the value of those go down. So that strategy in and of itself, not so good. On the other side of the coin, what if you're holding stocks? Well, stocks in an inflationary time tend to go up as well because what they were worth yesterday, if inflation has pushed the dollars up another 5% or 10%, or I think today's number was 6.2% annual inflation. Mm-hmm. So if we've seen that kind of rise, then typically those companies and the assets that they hold and the value they have has risen as well. And that works out fine until inflationary costs begin to put a stranglehold on profits, and profits are driven down because they're having to pay more for everything, and their workers are not willing to work for the wages they used to because they're having to pay more for everything. Suddenly profits are strangled and values begin to drop. And sometimes that happens in an inflationary time in a pretty dramatic way. Right now, if you really wanted to spend some time, you could find pundits that say we're not going to see any pullback in the market at all. We're going to continue to see growth going forward throughout 2022. And the most dramatic I've seen so far are several, not one, but several advisors who are predicting that there could be an 80% pullback in the markets next year. 80%.
Wow.
Somewhere between continued growth and 80% pullback is reality. So what you're really asking is, what are some things I could buy that might give me some inflation hedge? Typically, what most advisors will see, because you really can't predict the stocks and the bonds and the timing. When you time the market, you're almost always going to lose. The markets move dramatically in a couple of dozen days each year. And if you miss out on those couple of dozen good days, you're gonna mistime the market and you're gonna lose a lot of your benefit. So market timing, not great. Now I say that people who sold out and went to cash in January 2000 look like geniuses, because right after that, the market dropped dramatically and they had a lot of money that other people didn't have. Regardless of all of that, the point is there are some assets that will continue to thrive in inflationary times. Logically, those assets are things like precious metals, potentially real estate. And the reason I say potentially real estate is that in theory, if inflation is pushing prices up, it should also push real estate values up. But talk to the folks in Houston and Dallas about that when oil became such a difficult situation 15, 20, 30 years ago. Their real estate values dropped because of where the real estate was located. So again, one snap answer to this question is not going to be correct. But the precious metals are being talked about a lot, as are cryptocurrency type of investments as hedges against inflation. Two problems. The metals, the commodities like this tend to do this, and then they do this, and they plateau again. And so the problem is, when are they going to do this? I have a doctor client, whose name shall remain nameless, that bought gold futures for about 20 years. And they basically were flat during that entire 20 years. In year 20, he became a multimillionaire, even beyond what he had already accumulated from other sources, because they paid off in year 20. So he looks like a genius with the benefit of hindsight. He's worth $12-15 million. And he started out with maybe $500,000. So he looks really, really smart today. But if you'd ask him in year 18, his 500,000 maybe was worth 350. I mean, at that point, the futures just hadn't fired, the increase hadn't occurred. So while logically the metals will do really well, gold, platinum, silver, those types of things, even copper, in an inflationary time, there's not a great way to predict the timing. Most of these gurus who predict the next increases and how far it's going to go are almost always right on the numbers, but they struggle with the timing. Could happen next week, could happen next month, could happen next year. So that's one consideration. The other consideration, we're talking about cryptocurrency. There is theoretically more upside to cryptocurrency in inflationary times because it's not directly money-based, right? But we have no history to tell us how it performs in a time of great inflation. I have been talking to my own personal investment advisor recently about this particular topic. And of course, he frowns a lot and he says you really should stay well balanced and you shouldn't put a lot of dollars into this, but probably wouldn't hurt to put some more dollars into this. And so we've taken what was a 5 or 10% allocation for me and my portfolios up to 15 or 20%. And basically, if my market-based types of things they're not the other 80%, but if whatever they are, if they are to drop some, the theory is these other things will increase some because they move adversely to the stock markets. So we'll see. Again, we'll see. The past few drops in the market have recovered at light speed. There are some theoretical models out there. No one knows this. If your crystal ball is better than mine, please use it. But there are some theoretical models out there that simply say this recovery may not look like these last few that have been within a year or 18 months when the market has dropped. They're talking about models that more closely mirror the 1970s. In the 1970s, when we experienced a drop, the recovery was very slow and gradual and really didn't come about until in the 80s. So very prudent investing, very balanced investing, investing with a good investment advisor whose philosophies you agree with. Those are the right moves right now. As far as picking the next Walmart, I wish I could. I'd do it first and then tell you about it right after that. So again, good luck. I do think it's a concern. I think it's a valid concern, and I think that the markets will drop. I think they're overheated, but nobody knows exactly when or exactly how much. So I would suggest to you that you begin to have these conversations with financial professionals who can theorize with you and tell you a lot of specifics that we simply can't tell you from the standpoint of accountants.
Yeah. And especially as you get older in life, there are fixed income annuities that give out guaranteed monthly or quarterly distributions. Is that right?
Absolutely correct, Jordan. And more importantly, here in Louisville, Kentucky, and I know you're a Kentucky guy too, here in Louisville, Kentucky, there's 3 or 4 investment companies that make their living totally doing annuities. And all of the more traditional, pick your favorite again, Morgan Stanley or Merrill Lynch or Bear or any of these kind of guys, they all scoff at them and say, that's just ridiculous. That makes no sense whatsoever. And yet, as long as those insurance companies that back those annuities are sound and remain in business, you get guarantees. You get a guaranteed income stream with no real downside because the insurance company has more money than most small cities, and they'll be able to take care of that guarantee without any problem. So that is also a strategy. Again, the other part that's difficult about your question, Doug, is that everybody has temperaments when it comes to investing. Some people would really rush toward those banana plantations I mentioned earlier. They shouldn't. Banana plantations would be a horrible investment for so many reasons. But the bottom line is some people would say, I'm good with that. I don't mind the risk. Wow, we may make 10,000% in a month. I really want to do that. Not a sound strategy for 99.9% of us. On the other side of the coin, my dear mother, rest in peace, but she very much was a depression baby. And I had to literally drag her money out of CDs to invest in any kind of marketplace because she simply believed the markets were going to collapse as they did when she was a child. So, individual temperament, individual risk tolerance, individual goals, very important part of this process. And then dealing with things like inflation risk, which is super important. But you do want to make sure that an investment advisor is doing a great job of counseling you through all these things. We do a lot of advising in this area. We do not pick individual products or investments or bonds. I can talk to you all day long about categories and types of investment mix, but you don't want us picking individual investments because the guys that watch those every day as their day job can do that much better, and they have much better, as I like to say, toys than we do to help analyze what direction that an individual investor should go. We work with some tremendous ones here in Louisville, some people we would refer in a heartbeat. If it's someone if you'd like to have our connections to connect with, please reach out and we'll be glad to get you some names and some referrals to some groups.
Cool. Well, I hope that's helpful, Doug. It's definitely on everyone's mind. I saw the Wall Street Journal article this morning that came out October, was it 6.2, and it's been over 5% for the last, I think, 5 or 6 months. So it's definitely on everyone's, and that's not including food and energy. If you include food and energy in that measure, it's even a lot higher. So the number they're telling us is trying to keep us all calm, because if you knew the real number, you'd probably, your question would be even more. It is important. It's definitely everyone needs to be thinking about it. There's just not a lot of great options out there right now. Like Rick said, once interest rates do go up, you can have your money in some safe bonds that are paying a little bit more than they are now. But where we're at right now, it feels like, Rick, you tell me what your thoughts are, but it feels like there's not really a great place that's not risky. It feels like everything is like it could plummet tomorrow. And whether you're in you're in an index fund, you're in even one of the big tech companies like Apple or something, or you're in a Bitcoin, it just feels like everything's great, but the economy that's underlying in some ways doesn't feel great when there's supply chain issues across the board and all this. So it kind of feels like we might be sitting on a house of cards.
Yeah.
But again, to Rick's point, we also could experience growth for the next 5 years, and then the crash comes. There's just no way to know. So
Well, when you look at the last 15 years or so, almost 15 years, let's say 13, back to 2008, we've had an unprecedented period of growth. There is almost always a 7 or 8 year rhythm to growth, pullback, growth, pullback, growth, pullback, until 2008 occurred. The pullback occurred, it was severe. It was all segments. Virtually everything dropped except for gold and silver. Gold and silver did okay during that period. But what happened from there is that the growth has occurred and gone forward and forward. Why do the markets pull back? They're very much like rubber bands. The amount of elasticity as far as being able to stretch the numbers bigger and bigger and bigger and bigger begins to decrease as the rubber band gets tighter, right? Eventually it has to break, comes back. When it comes back, then we retract and we begin that march again. It's like a dance, really. It's very much like that. So the bottom line is we've had an unprecedented 13-ish years of continued growth. Almost never happens. It should have pulled back around 2016 or 17. It didn't. It was predicted.
mm-hmm.
Predicted today. It didn't happen. So bottom line is the rubber band has continued to stretch since then. Now, there will be people who do analysis and say the fundamentals of the market are sound and it's not really as overheated as it looks. But those are all opinions. And one of the cool things about the investment market is also one of the infuriating things. It really moves based on people's perceptions, not necessarily mathematics. So what I will tell you is based on historic studies of gold and silver and those types of things, this is one man's opinion, because I'm certainly not going to be buying all the gold and silver that are bought over the next 6 months. There'll be millions of people that are involved in that. But the numbers are unnaturally low right now as compared to what they should be in the marketplace. Does that mean they're going to go up? No guarantees.
Yeah.
But it does seem like a place where the numbers can't go a lot lower currently. Again, not assured. But just because they have been stagnant around these really low values for quite some time. So in theory, the gold and silver investors all talk about floors. We're probably at 4 right now, which means if the stock market drops 25%, gold and silver probably will not. But again, absolutely no assurances. So get with someone who's smarter than I am and let me talk to you about this.
Yeah. And to piggyback on that, I mean, if you're trying to decide between crypto and gold and silver have a much, much longer track record for you to go dig into and look at. Whereas Bitcoin and those types of things they're still very speculative in nature. And if you are in the age group that you cannot lose wealth that it's taken you 30 years or so to build up, you definitely want to make sure, again, going back to Rick's points of balance, maybe you have a very, very small amount in crypto, but you're increasing some of your gold and silver to hedge against that inflation. But I do feel like I get a lot of people who compare gold and Bitcoin, and I just think we don't have enough data yet to know if it really, like, we just don't know how it will react if the market overall plummets. So anyways, all that to say, depending on your age, it's always an age question of like, and your tolerance of risk and all those things. So, but yeah, take a look at gold. So Rick, we've got contacts, right, to point people to.
Absolutely. Yeah. The GBTC moved to the point. That's an ETF, an exchange traded fund that actually mirrors Bitcoin. That's even available through the brokerage houses now. Yeah. It was not very recently. So anyone that does investment advising who's good at what they do is going to have the tools available to help you do anything that you want to do, whether it's invest in paper-backed gold and silver, or whether it's to invest directly in actual hard currency gold and silver. There's lots and lots of ways of doing that. But what you really need is you need some education, and you need to know what is a match with you individually. And again, the investment advisors we work with, they're gifted in that way, or I wouldn't refer them. There are dozens and dozens and dozens and dozens in Louisville, Kentucky. There are a handful that we will refer because they truly stand out in their integrity, their competency, and their ability to work with a variety of different types of clients. So if we can help you, please let us know.
Cool. All righty. Well, that's all the time we've got for today. So I hope all three of you that submitted some questions, I hope that was helpful. And if you're listening along, if you've got questions, make sure just to submit them. You can just put them in to our email at it's accountant@aia-cpa.com. And if you would just put question in the subject line, we'll make sure those get to the right place, and we might answer them next week or beyond. So thanks so much for tuning in. We'll see you guys very soon.